Hello? We'd like to start the next session. First of all, thank you Google Lunar X Prize for sponsoring the networking break. The final panel of the day focuses on the capital that fuels our passions. Moderator is Amir Blachman, Managing Director of Space Angels Network, the leading organization for funding early-stage space companies. Please join me in welcoming Amir and the panelists.
Thanks, Curtis. It's truly a pleasure to be here. The Space Foundation's NewSpace conference is a catalyst of space exploration, and their board of directors and volunteers continuously provide us with a world-class event, and it seems to get better every year. So why don't we just give them a little round of applause for all the hard work that they've been doing. This morning, I spoke with Doug King, president of the Seattle Museum of Flight, and we got to talking about historians will write about our era. The conflicts will be in the books, but so will our rise to the air, the rise to data, and the rise to space. Living at this inflection point is important to the context of today's discussion. At Space Angels Network, we surveyed our members in May about why they invest in space, and I'd like to share a quote from Space Angel Nathan Kaiser, who's based in Hong Kong. Nathan is an attorney. He's a sharp investor who asks tough questions, but he also shares the vision, and here's what he wrote. The protagonist of a German novel used to say, "Always be 2 steps ahead." I think this goes for individuals, companies, but also humanity. I personally can't build these rockets, satellites, and spaceships, but at least I can help to finance them. Down the road, I want to tell my kids I was there when it all got started, and I believe it will be my children and children. Doug's vision of how history will see us and Nathan's desire to create a legacy definitely play into investors' mindset, and we'll touch on that today. Also, the fact that this investment discussion graduated from the sidetrack breakout sessions and now moved to center stage reflects the times that we're in. So since 2011, non-government investment has taken off. 2015 saw $2 billion raised in the first half, and that is exclusive of acquisitions and IPOs. Some notable fundings included Planet $1 million Series C, Spire's second $40 million round, and Black Sky's $20 million raise. Seraphim Capital in the United Kingdom recently opened an $80 million aerospace venture fund, and OneWeb secured $500 million, which came from the combined investments of the Virgin Group, Airbus, Qualcomm, and Coca-Cola, and this investor mix is becoming more typical. In terms of ground-level activity, Space Angels Network is hearing from a growing number of space startups each month and receiving increasing attention from investors applying to the network. Earlier this month, in 2 days alone, at the ISS conference in Boston, we heard pitches from 14 companies, and we're currently evaluating over 150 applicants for funding. This morning, Eric Stallmer, the president of the Commercial Spaceflight Federation, talked about the vision and inspiration that space exploration evokes in kids and STEM educators. And we see that same effect on investors, both in their investment choices and in their desire for legacy investing, wherein they want to serve the double bottom line of profit and on improving life for humanity. This afternoon, we're going to hear from a spectrum of investors and get a better understanding of why they invest or don't invest in aerospace startups. Eva-Jane Lark, on my left here, is a wealth advisor and vice president at BMO Nesbitt Burns. She invests as an angel investor and represents her clients in a wide variety of asset classes. Joshua Ben-Amram is a member of the investment team at Bessemer Venture Partners. He has a strong background in private equity investment, and at Bessemer he focuses on high-tech markets, cybersecurity, and the Internet of Things. Steve Jorgenson is a partner at Space Finance Group, and he is a founding partner of Space Angels Network. He's an accomplished options and hedge fund investor and now focuses his attention on early-stage aerospace investment and on a special project called the Integrated Space Plan, which we'll hear about in a few minutes. Gareth Keen is an investment manager at Qualcomm Ventures and as such represents the more corporate side of our investor panel today. Gareth's background includes many years in senior technical leadership roles, deep venture capital expertise, technology mergers and acquisitions, and he sits on the board of several aerospace companies. So with that, I'm going to join our group. So, Eva-Jane, we'll start with you. The entry of institutional investors such as Fidelity into SpaceX means that perhaps aerospace investments, certain aerospace investments, represent a better risk-return opportunity in the eyes of institutional investors than some other investments that are out there. And some people say that the moon economy is about to flourish, and some people say that that LEO is the next mega market, and then some people say space is just too risky. So who's right?
Probably there's a little bit of truth to all of those positions. I found the Fidelity investment in SpaceX really interesting. To a certain extent, I think a lot of us who, if SpaceX was a publicly traded company, I would guess that a lot of hands would go up to say they were shareholders in the company just because of the Elon factor and the success of Tesla and the success of Solar City. So, but it's still interesting to see a company like Fidelity invest in it. Planet Labs I found particularly fascinating because I didn't even know the International Monetary Fund had a venture capital division, and they invested in Planet Labs. I was really hoping that maybe we'd hear the story of that particular one. So personally, I'm definitely very interested in what's happening in LEO, but to get to LEO, you still need launch vehicles and things like that.
Just a quick comment on that. From the general sort of venture capital universe, all these public market investors like Fidelity are heading earlier and earlier in the food chain. You know, they're busy spraying money into all kinds of crazy private companies. So I think it's just a symptom of that general move away from the public market to late stage private companies by a lot of these public asset managers.
I would agree with that. And I think it's a symptom of our times and conditions of the macro economy. When you see yields lowering, you see big funds like that moving into earlier stage, more risky investments because they have LPs that say we want to see higher macro economies and capital markets are offering. So I am a bit skeptical of that being a sustainable source of income for high growth startups.
So, Josh, Neil deGrasse Tyson said that the first trillionaires that the world will see will be those people that exploit asteroid resources. And we all know in this room that it's going to take a long time to get there, and we know the time value of money. So on that note, what is your investment horizon? What's your hold period? And does a $1 trillion exit, like exploiting an asteroid, extend that time horizon, or is there something that kind of set in stone?
Yeah, you know, I'm not sure how literal Neil deGrasse Tyson was being with that statement. For me, that does seem like, again, another area that I'm skeptical about. I think it's a lot farther into the future that it's a feasible model. We just saw a presentation about the $1 trillion, I think $25 trillion was the figure that was quoted. That may be the revenue opportunity, but that doesn't, or he didn't address the cost and the relative cost versus what we can achieve here on Earth. It reminds me a bit of the early talk about the solar market when that technology was just on the horizon, no pun intended. And people were saying, thank you, people were saying the sun up above, it's an infinite source of energy. This will solve our energy crisis, and we'll never have to go drilling for oil again. But then the technology was deployed, and you saw that the relative cost and the relative yield of solar panels didn't quite match up to what was achievable here on Earth drilling in the ground. So I think eventually solar technology and asteroid mining gets to the point where that economic case can be made, but I think it's well into the future.
And where do timeframes fit in, especially when you're looking at aerospace companies?
It's a case-by-case evaluation that we're making, and it's an evaluation where we take in a lot of factors. You know, if Elon came to us and said, I have what it takes to mine asteroids, and it'll take 10 years, I think we might be interested. But we do need to go and explain to our LPs who, in this economy, again, are looking for quick returns, high yields, that this is going to be a little bit more long-term of an investment. But, you know, it's all relative.
And Steve and Eva-Jane, as angel investors, how about for you? How does time play in?
I think a lot of time frames differ, and when you're investing other people's money as opposed to your own money, so from an angel perspective, your time horizons differ. There's a lot of opportunities, I think, as an angel investor that you're prepared to look at and say, You know, this is a company I want to be involved in, and I want to be involved in it as long as it exists, and hopefully it'll be a long time, and it'll be part of my, for my children eventually. But that's what you do when you invest other people's money. When you're investing other people's money, you really have to have their time frame in mind, and you have to have an exit strategy for them, which you may not necessarily or an angel investor may not have for themselves. I mean, ideally, you do want to for sure have some liquidity at some point in time. Just a quick aside, though, on the whole asteroid idea. I was at a conference, PTMSS is a mining-focused planetary science conference that has, when it's in Canada, it's held in conjunction with the Canadian Institute of Mining. And 2 years ago, when it was in Toronto, Chris Lewicki of Planetary Resources was on the plenary panel with a couple of financiers and a couple of other individuals. But both of the financial people hadn't heard a pitch by a space mining company before this, and both of them, including the head of our corporate finance for mining, said to him after, "Come talk to us." Now they know that it's way too early for them to invest, but they're interested and they're watching, and I think that's an important part of it, is that there's a lot of people watching.
Well, when I look at them as an angel investor, I guess I kind of group them into near-term opportunities, medium-term opportunities, and long-term opportunities. If you're going to invest in just one company, it really doesn't matter which one you pick. You can take the long-term opportunity and then go about your business. I personally kind of like to pick a little out of each one, if I can, build sort of a rolling portfolio, so to speak. I plan to be in the game for a long time. It would be nice to have some near-term exit opportunities so that you can roll that money into new investments. If you invested only in long-term opportunities, you'd soon be out of money and you'd be out of the game. So I guess that's how I'd look at it.
So Gareth, I'm going to tee you up for a different question here.
Sure.
A few days ago, Peter de Selding from Space News interviewed Peter Platzer, the CEO of Spire. I want to read you a quote. Now this is me quoting somebody. So Peter Platzer, I apologize if this isn't totally accurate, but he said, "Britain may be Europe's best in venture capital, but that it is like an adult outrunning 6-year-olds in a 100-meter dash. The better comparison is with the United States, where there is 15 more times venture capital than in Britain. Risk appetite in Europe is just lower." I'm not saying this is a difference. You don't have investors in Europe comfortable in taking risks. In the US, raising $1 million in seed capital is a 2-week story. Raising $1 million out of an incubator where you finish the 3-month program and you can choose between 5 top-level investors who want to give you $1 million and you still don't take it. Series A is a different story and Series B is yet another. So Silicon Valley over the years has demonstrated a higher risk for appetite. Higher than Europe, higher than other places. And my question for you is, do you think that now that we're seeing that translate to space is an investment heritage of Silicon Valley, or do you think that there are other factors going on here that are keeping as the highest appetite risk region?
I think it's a historical artifact. You know, Silicon Valley really has become this amazing nexus of innovation and finance of innovation, which is orders of magnitude ahead of anywhere else in the world. You know, I've worked in other parts of the world, and you know, there's nowhere else like the Valley. And I do believe that will translate into, and it has translated into areas like biotech, where a lot of the leading biotech investors are based in the Bay Area. I think it will translate into NewSpace. I think we'll find that a lot of the more interesting and aggressive and risk-taking investors who are putting money into space companies will be coming from the firms on Sand Hill Road.
Do you think it has something to do with NASA Ames being here? Because there are other space development hubs in other places in the world that aren't necessarily connected, but do you think that that and other programs here are affecting it?
It could be one of the factors. I think it's very hard to point to any particular reason why Silicon Valley is Silicon Valley. You know, other areas in the world go out and try to become, you know, the next Silicon Valley, the Silicon Valley of Britain or the Silicon Valley of China. And it's very, very hard to replicate. I don't think anybody will be able to do it. It's just a confluence of, you know, history, of, you know, smart people, of smart money, of an appetite for taking risks. Sure, Ames might have something to do with it. I'm sure it does. There's a lot of smart people who've come out of there. But it's only one factor in sort of a multi-dimensional equation.
Yeah, I think money will follow IRR. and rate of return. I think if we see more density of high growth exits in areas, then you'll see more capital being deployed in those areas. Whenever you see New Mexico is the Silicon Valley of the Southwest, or New York is the Silicon Valley of the Northeast, it's because there have been a few high growth exits there and capital started to flow in those areas. I think another more high level factor that's contributing to this, and I apologize if I offend anybody from this area of the world, but I think there's a flavor and a spirit in Silicon Valley and some geographies that have seen this kind of investment of sharing information, of trusting your competitors and your peers in the market to a certain degree, and open standards being worked on, and raising the floor for everybody. There's a trust coefficient there that contributes to innovation where capital follows. And I don't think that's quite the spirit yet in Europe, in many of the tech centers. And we're starting to see it. And I think Berlin has been an area where VCs have been excited about, but hopefully things move in that direction.
I just also wanted to comment that I think Silicon Valley is Silicon Valley, and it is very unique. Having said that, before the focus on AIMS on the commercial sector and on NewSpace, I don't think that Silicon Valley was interested in space. So I do think AIMS has a lot to do with Silicon Valley's interest in space.
I'll just add a quick plug for Bessemer. We do invest in international companies. If you can't find funding in Europe, give us a call.
So, Steve, keeping a high-level view, can you tell us a little bit about the integrated space plan and the perspective that you developed on that? And after developing that, what areas of space interest you now, and where do you decide to invest? What areas of space you decide to invest? And you can't tell me what you told me this morning, which was wherever Space Angels Network tells me.
Well, that's a good start. Well, I had the pleasure of meeting Ron Jones, who did the original integrated space plan in the 80s, and we wanted to bring it back. It was basically a roadmap combining all the technologies, that were how you'd go step by step through where we were then, to actually have humans running around the solar system and beyond. Very complex flowchart. It blew me away the first time I saw it, and I immediately wanted to dig in and see what was going on, because when I first saw it, I was a little bit new to the industry, and I didn't maybe know all the technologies that were in play. So over the last year, well, I should mention we did a Kickstarter last year for it, and the Space Frontier Foundation was very helpful as a co-sponsor on that. It took us literally a year to put it together. You can see the end result in the next room here in the exhibits hall. But it was a fascinating experience just to see how all these things fit together, because you hear all these space companies that they have a technology here and they have a technology here, and this one wants to do that and that one wants to do that. But you really don't see how it all fits together unless you have some kind of a visual source. At least I didn't. I'm a visual person. There's tons of roadmaps out there, excellent roadmaps. When you look at it, don't think of it as a central planned progression. It's more of a this is one vision for how it could unfold, and I'm sure every year things will be changed, and somebody will jump up. I think right now we've got a human landing on Mars at 2044 or something like that. There's lots of people talking about doing it in the 30s. There's some people saying it's not going to happen until the 60s. So as things develop, that changes the way we look at things. But I guess one of the best things I learned from the experience was seeing where the roadblocks are for space development. And maybe we should be putting a little extra focus on those in the investing world, if we can, and power through so that all the other technologies and all the other advances can keep going forward. Specifically, what I saw there?
What's interesting right now?
Small sat market is the current hotness, I guess you could say. looking back toward Earth, imaging, communications, the data processing, the number crunching that results from that, that's probably your near-term, your best near-term bets. A little further, let's see what we've got. We need better low-cost launch system for the small sats to open up that market. Going a little bit beyond this, and this is my personal opinion, I think we need a lot more bioscience research in space. I think it's a seriously untapped market that not just financially would result in a lot of windfalls, but could be very, very transformative for a lot of industries and in general. And I don't think it would take that much to get that going. You just need dependable launch and being able to conduct these experiments in a systematic fashion. I mean, that's been the holdup until now. When you put I have a background in life sciences. When you put an experiment together, you can't let it sit on a launch pad for weeks and weeks and weeks. You've ruined it. You need to have a dependable launch schedule. You need to have people, usually you have people, you can probably automate a lot of the activities now, but you need to have people or automation on station that can actually conduct the experiment in a systematic fashion, and then you need to get it back in a reasonable time frame so that you can actually use the results. And I think if you can do that, you will find some amazing genetic and life cell discoveries.
And so Gareth, if I evolve the question a little bit more for you, what are the areas that you set out to look for an investment, and what are the areas that you find yourself actually investing in?
So from space in particular, or, okay, so obviously Qualcomm, if you guys don't know, Qualcomm is a big US technology corporation that specializes in sort of radio communications and mobile computation. So we typically make investments somewhere around Qualcomm's core business, not necessarily things that are super strategic, but more ecosystem related. So Qualcomm has had a pretty long history in satellite communications from companies like Globalstar in the 90s through the OneWeb announcement, which you referenced recently, which is the idea of providing broadband satellite comms to the unconnected 5-6 billion people in the world. So, pretty interesting. We're trying to find investments that will sort of be synergistic. It could be radios, it could be data platforms, which will leverage radios. We've actually just made a co-investment with Bessemer, in fact, which we're pretty excited about. And we're also looking then at other sort of enabling technologies that could be helpful for Qualcomm's efforts going forwards. Now, saying that, while we do make strategic investments or semi-strategic investments, we are number one focused on financial return. So for us, the sort of timely, whether it's a 1-year return to a 7-year return, a good financial return would be number one on our checklist, definitely. But we do write checks from, much like you guys, from very early stage, 200, 250K to seed state type brands where entrepreneurs are just getting their businesses up and off the ground. And then we also write much, much larger, multiple tens of millions of dollars checks for later stage businesses. So really it's sort of somewhere on that continuum of risk versus reward. We'll have different criteria. At the very early stage, it will all be about the entrepreneur and about the idea that they have. And at the later stage, where a lot of the risk is gone, it's more about the financial outlook, what the return will look like, what the business looks like, and how that business will scale as you throw money at it.
And what's that translated into space segments recently?
So we have recently invested in I guess you could call it a data platform, sort of a services that sit on top of a constellation of nanosats, focused on areas like M2M and some interesting sort of emerging environmental monitoring applications.
Do you guys want to tell us a little bit about what areas?
I wanted to expand on one of the things that you said, or two. The things that really interest me, and I think are things that enable other things to happen, and I think that that's really important, and also the ecosystem. So the perfect example is Apple and the iPhones, and how the apps have made the phones and their equipment indispensable. And so one of the things that I always look at when I'm looking at an investment is, what does this enable, and what else can be done because it exists.
I think any investor will tell you a platform is what they're interested in.
Yeah.
Right? Building a platform is the most exciting thing in the world.
Right, but not always a data platform. So the word platform, I find, it was probably used more frequently, but it's almost like the ecosystem is more important that surrounds it and that depends on it.
I would push back on the platform being the most interesting part, and CubeSats being a great example. At least platforms being the most attractive investment opportunity. So the CubeSat platform has opened up amazing innovation in the small satellite. That's what we're most excited about at Bessemer right now, is the launch. Stephen talked about the bottleneck, and we invested in Rocket Lab to help address some of those agile space issues. So the launch, propulsion, the different science payloads and applications and analytics on top of that are being deployed now on top of CubeSat platforms are all very exciting. What tends to happen with platforms is that they become commoditized very quickly, and we're seeing this now in Earth observation at least. You have a deluge of small satellite companies and CubeSat companies coming out, and people start talking about, well, when diminishing marginal returns. And I personally think a bit of a hype cycle, and we're going to see a dip and then an explosion again, much like we saw with the internet and the dot-com boom. You had a boom and a bust, and now when you look back, you see that the value accretion from the internet dwarfs the losses from that bubble, from the dot-com bubble. So I think it's a very exciting ecosystem that reminds us of when the Model Ts were first coming out, and that kind of interoperability and economies of scale became introduced to the automobile market. We feel that it's a good parallel for what's going on in CubeSats now.
So are you saying that if you want to be a good space investor, at least Eva-Jane, Gareth, what you're saying, perhaps what you want to invest in is EUV and the new photolithography and the chips that will power the cell phone type technologies that will power the nanosat?
So I don't necessarily think that's true. Like, one interesting sort of corollary or sort of analogy we make is around UAVs. I'm not sure if anyone's been tracking the UAV industry, but you've seen an explosion in sort of the consumerization of that industry, where the sort of existing behemoths like the General Atomics and the Boeings are really being challenged by sort of low-cost, innovative companies, which are coming not just from Silicon Valley, but also from places like Shenzhen. So we think that there's an opportunity for companies in the NewSpace sort of sector to do exactly the same thing. So it's not necessarily enabling technologies. It may be, from a financial return perspective, data services that sit on top of these platforms, which might be the most financially rewarding because they can scale like crazy. You don't have to get stuff up there. You just use somebody else's hardware.
So I'm going to ask the audience to do something for me, to get a sense of the people that are in the room here. If you had to categorize yourself leaning more towards being on the investor side or being towards the entrepreneur side, how many people here would put the investor side? And how many people would put themselves here on the entrepreneur side? Okay, good.
Well, you entrepreneurs, watch for those investors, though.
Yeah, investors, put your hands up again. Okay, everybody kept them down. All right. Let's serve that entrepreneur audience for a moment. I'm going to give a 3-minute primer on what Space Angels looks for when we look at early stage companies, and I'm going to turn it over to the rest of the panelists to round it out, a more complete picture, not only what the criteria are, but then we'll go also into giving some helpful hints and things like that, and then we'll open it up to audience questions. So in terms of Angels, there are a few umbrella areas that we look at. And so those include the team, the product, the market, the competition, some other areas. A little more specifically, we look for products and services that clearly answer a customer need. And while that product can be technically complex, it's important that you're able to explain customer's problem better than the way that customer's problem is being solved today. And it helps even more if you can say how your product will make that customer more competitive in their market. We look for a strong team, a team that has experience working together, that contains the right combination of skills to carry out the business, that has an understanding of what their business really is. So are they a data business? Are they a hardware business? Are they some kind of combination in there, so they have a clear understanding of what drives revenue and what is most profitable for what they're trying to carry out. We're looking for leaders who are willing to be coached or willing to step aside if the business outgrows them. Importantly, that they have a realistic understanding of what their own capabilities are relative to what they're about to try and do. We're looking for teams that exhibit clarity, perseverance, leadership, accountability, And we also ask ourselves when we look at founders, and sometimes we even do this unconsciously, is this somebody I would want to work for? Because that person's going to have to build a team. We look for an innovative product that is durable to competitive entry. We look for a big market and a well-defined path to capturing at least the first niche within that market. We're looking for a strong understanding of competition. So we want founders who aren't operating in a vacuum, no pun intended. We want to know that they understand the costs associated without doing the competition at the beginning and in the long run. And we want them to understand how their competitive costs will affect their financial performance. So we also like to see a reasonable plan for how the product is going to be sold into the first target market niche, and whether the technology and whether the sales plan for that technology can be other markets, or are they going to target one small market, saturate it, and that'll be the end of the business. And then lastly, we look at the financial plan, and there are three main elements that we look for. First of all is, do the terms of the investment leave room for the investors to have some significant upside? The second is, does the amount of investment being sought give the company enough breathing room for growth and longevity? So they're not just looking for a quick bit of cash to hold them over for the next tiny milestone, but really is enough being raised to get to where they need to raise. And if not, will subsequent investment rounds dilute the investment so much that the opportunity starts to not become a little bit less interesting to investors? And lastly, we're curious when we look at founders, are they looking for money from a strategic set of investors? Somebody that can bring them clients, somebody that can bring them technical expertise, somebody whose network with other companies they invest in can create inter-synergies among the various companies that were invested in by that investor? Or are they coming out just to look for money, for wherever it might come from? And if the money that's being sourced is strategic, it tends to help a little bit. That last one I want to talk about just a bit more, because for Space Angels, it's particularly important to have a company that we invest not only money in, but that we can make the value of our investment grow by leveraging our network. So I'll give you an example. We had a company come to us recently that wanted to raise $10 million to put their technology on a satellite that is free. And we suggested to them that instead of doing that, we could use our relationships to help get them on ISS, on the International Space Station, and by not building a free-flying system, they would ultimately only have to raise $3.5 million, start generating revenue off that particular technology that's collecting data while on the ISS flyer, and then be able to use that revenue to start putting out the constellation of small satellites. It's a different model. They let go of less of the company, they utilize our resources. We can also bring them in-kind resources from our big aerospace partners, irradiation chambers, vacuum chambers, bench expertise. So that's something that's important to us, and that's where we have the edge over a more generalist investor. So that's a brief overview of everything that we look for, and I'm sure there are things that I haven't thought of, but I'm very curious to hear what you guys think.
Well, you were very comprehensive. The one thing that I find, and having been a judge in some of the business plan competitions, and when I look at investments myself, is I always pay very close attention to the assumptions that are both stated and unstated, and I'm always amazed at how little business plans or entrepreneurs address the assumptions, because the first thing that goes to my mind when I'm going through it is, and I even write it on pages, is, okay, they're assuming this, and they're assuming this, and if my evaluation of those assumptions doesn't match, it's gone. You know, I rule it out very quickly because I don't believe that they tackled the whole assumptions and the risks involved, and they don't really understand the path very clearly. But stating the assumptions is wonderful, because then you know, okay, they've thought it through, they haven't just ignored this, and they are not going to be caught in left field. So stating the assumptions and actually addressing them, I think, is really important.
I don't think I'm going to add anything new, but to underscore a few points that you made, for us in this market, near-term revenue opportunity is paramount to when we invest. Bessemer's been investing in software and internet technology primarily for the past 20 years. And when we have a software company and a space tech company in front of us, even though costs are shrinking and barriers to entry are lowering in this space, the capital requirement and the return profile for the space tech company, well, I'll say at least just the capital requirement, is still daunting compared to the software company. The return profile might actually be a lot more attractive in the space tech company. So having a really strong pipeline to early revenues where a company can turn self-sustaining and no longer need more investment is really important. The other area that's becoming more and more important, especially with the CubeSat standard and SmallSat standards, which I think are great and opening up innovation in the space, is having a defensible product that you can rationalize against the activity of other competitors. So these two areas are becoming very important for us.
I guess I'll boil it down to one thing here. After poking the business plan every which way you can to try to find wrong on this or wrong on that, and they answer successfully, it really comes down to the question of, do I trust the management team to execute the business in a successful manner? And being able to adapt along the way. Because whatever their business plan says, if it's a 10-year business, it's going to look completely different in 10 years than what that business plan said. So are they able to adapt? Are they able to push their vision? And do they give me the confidence that they're going to be successful?
And for all the entrepreneurs that are out there, what do you base that sense on?
That is a very hard thing to say. There's really no metric I can say on that. You kind of just have to get a feel for them.
So you're looking at resumes, right?
Yeah.
You're looking at past successes.
Past success, of course, even though I have to say legally that past success is not an indication of future performance. When I'm looking at an investment and I'm looking at the management team, it seems to be that way. Yeah.
Do you usually meet the founders in person?
I try to every time, yeah. Yeah, if I can't, I schedule at least a good call on it. But you don't get the feel over a call or a static PowerPoint that you do by actually meeting somebody, talking to them, seeing how they react in a social situation. Yeah.
Yeah, I think everybody's added a lot of value with their comments. I've got a couple of things to put in. I think for me, there are really three questions I have first time I sit down with an entrepreneur, which is, why you? Why are you going to solve this problem? Well, why should I believe in you? Second one is, why this? Why this problem? Why this product? Why this market? And the third one is, why now? Is it the right time? Especially in a sector like space, which has traditionally had quite extended timelines, it can be quite a high hurdle to get over to convince us that this is really the right time to invest in your company. Just a couple of other thoughts. I think, Amir, you mentioned this. As an entrepreneur, especially as you're trying to raise money, it can be hard to internalize this, but really money is a commodity. The interest rate is the price of money. You can raise money from me, you can raise money from Joshua, you can raise money from pretty much anybody. And there's a lot of money, especially in places like the Valley right now. I think it's very, very sort of incumbent on you as an entrepreneur to figure out which money adds the most value for you. Because money from somebody like Qualcomm comes with certain advantages. We have a very large, very strong technical engineering organization that we can dip into and help our companies out with occasionally. It comes with sort of relationships with the Qualcomm ecosystem around carriers, around equipment OEMs, which can be companies in some sectors. And then if you take money from somebody like Bessemer, they bring their own set of relationships and networks, which you as an entrepreneur should understand and be able to leverage. And then I think that's pretty much all I had to add. Yeah.
So let's give...
Oh, actually, one more thing. Sorry, yeah, before I go. One other thing is that it's very unlikely I'll write you a check the day I meet you. It's going to be an ongoing conversation, especially, I'm not an angel investor, so it's not up to me to kind of parse through 100 business plans. And
we write checks right away.
Yeah, I'm sure you guys do, right? That's what I hear. That's what I hear from all the entrepreneurs. Oh, the angels wrote me a check yesterday. So for us, it's very much an ongoing conversation. So for example, we just put some money into a NewSpace company, but we've known those guys for close to 2 years, and we've tracked them from very early in an accelerator, saw them through their seed, saw them through their A, decided the time wasn't right, and just by a sort of a process of becoming more comfortable with the opportunity, becoming more comfortable with the team, it eventually became the right time for us to write a check. So,
let's put out some tips to entrepreneurs. Everything from when they pitch, how they prepare their decks, any pearls of wisdom that you want to share.
Well, the first thing is to listen to the feedback. and ask for feedback as well. If someone says, okay, you know, with me what I did like and what I didn't like, even if I choose not to invest, that's an ideal opportunity, because the closer you get to overcoming the reasons that someone didn't invest, the more likely you're going to find someone who does. So I think it's very important to ask for and listen to feedback.
From day one or prior to day one, be constantly talking to your potential, check your assumptions. The next one would be, if you're in discussions about intellectual property, before you put any signatures to anything, talk to mentors, engage a lawyer, and make sure that when someone's telling you you're getting a good deal, they actually mean it and you're getting a good deal.
This one's going to probably come back to haunt me, but be persistent. If somebody doesn't get back to you one time, you send an email out, you're all excited they're going to get this great opportunity to talk to somebody, and they don't email you back. Maybe they were doing something or they missed it or whatever. Keep trying, be persistent. I've actually made investments I initially would have dismissed just because the people keep coming, keep showing their enthusiasm. I finally get it, and then I invest.
Just a couple of things from me. I think, you know, presumably everybody at this panel is incredibly busy. A warm intro from somebody I know well would be very, very helpful for getting on my calendar. You know, I tend to respond to emails from people I know who say, hey, you should meet entrepreneur X. He's an awesome person, or she's an awesome person. That will get on my calendar much faster than some random business plan landing in my inbox. Let me see, maybe something else I had in the back of my head.
Something on brevity.
I don't know if brevity is important. I mean, we're all busy, but the most interesting meetings I have are where I learn something. So you can come in and teach me something I did not know. That's super helpful to me, and I will remember that. So that's another thing. Brevity is not necessary. I mean, if it takes an hour of a conversation to me to come out with an understanding of a market or your business that I did not have before, that's actually pretty helpful.
So I'll give a couple of tips too. In the meantime, whoever wants to ask questions can start coming up to the mics, and we'll take those questions in a few moments. But a couple of things that have been told to me by VCs and angel investors, and that we've experienced ourselves, is when you set out to raise money, and now I don't know if it's probably not this way with institutional investors or corporate venture arms, but on the angel side and on VC, it's a lot easier, or at least faster, to raise money between January and May and September to November. Summer months and the holidays, you can spin your wheels and work very hard and not get a lot of effective feedback during that time. And take that into consideration when you put together your operating plans, because that might have a cash ramification to plan for. Another thing, and this goes to what Eva-Jane said, is there's a saying, I don't know where it's from, but if you ask for advice, you get money. If you ask for money, you get advice. So if somebody doesn't answer you or says no, ask them why.
And I think that's true. When you ask someone for advice, a lot of the time you're telling them your story anyhow, and they say, hey, I'm actually kind of interested in that, and you didn't ask me for money, so I don't have all my up, and so I'm far more, and I find it's very true for job hunting as well. If you ask someone for advice, then they may like you and hire you, but also they may invest in you as well. I think that's a very good point.
All right, please go ahead.
Hi, my name is Enzo Vito. I raised my hand for the entrepreneur side. Going to what was said earlier, I think Josh said it about Silicon Valley's risk tolerance compared to the rest of the world. I found that a lot of like aerospace-specific startup accelerators are located in like the UK and like Australia. And, keeping in mind, again, what was said earlier about get money from people who can help you, what are your guys' opinions on applying to startup accelerators that are located in Valley, Y Combinator, Techstars in New York?
I'm not sure I have a great answer for that. I would say get to know the mentors at every accelerator before you make any deals and understand if they are really the ones that you're looking for. I'm not sure. I didn't know that about accelerators in Europe. I'll take a look.
Yeah, I mean, we deal, much like people at Bessemer do in the Valley, we spend a lot of time looking at the companies that come out of accelerators, and we're pretty jaded on accelerators, to be honest. We believe Y Combinator, Techstars, 500 startups, a couple of others are super high bars, very, very. I think the return that you get as an entrepreneur from an accelerator diminishes very quickly below that sort of top tier. I mean, if you're a hardware company, I would encourage you to go to Y Combinator. There's no better probably platform to learn and be mentored and learn how to build a great business than Y Combinator and Mountain View. But the other sort of flip side of that is, as an entrepreneur, never forget, the most important thing you control is sort of your equity and the control of your company. Whatever you're asked to give up in return for that help from an accelerator can be pretty expensive over time. So.
Thank you.
I actually have a macro question to ask the group that might be interesting. We had a gentleman on earlier from Deep Space Industries who was focusing on the macro of your business cycle, your economic trends. Where are we right now in that? Because it seems like money is really easy for creating the unicorns and the super unicorns out here in Silicon Valley. What happens when that changes? When does that change? If that's going to change, because it always has.
That's the question of the day. Always the question with venture capital is, where are we on the hype cycle? I think what we are starting to see again with cube satellites and small sats is that it's starting to feel like, with this ramping up of more Earth observation applications and more companies launching satellites, that portion of the puzzle is going to be commoditized fairly soon, and that people like Bessemer may be looking at other areas of the stack. But I think we are on the hype cycle. We'll see a small dip in correction, and then when technology starts to mature, we'll see an explosion in real value creation.
Adrian?
Yeah. So a number of VCs will say they will. Is this better? Okay. A number of VCs say they will never invest in any company that does not already have paying customers. They're used to software.coms where, yeah, with zero money, you can put up a website, you can get customers, maybe get a little payment. Obviously, for hardware companies, especially for anything where the minimum unit costs at least $100,000, that's not going to happen. Any advice on overcoming that?
Have you heard of Facebook, WhatsApp, Twitter, Snapchat?
Yes.
The paying customer problem is, and it is maybe a problem. I think VCs are past that way of thinking. In space, you're absolutely right, and that is because of the large capital requirements here. And I think for us, it goes to, if you don't have paying customers yet, and that takes, if the first money coming in depends on you having a satellite deployed, but you need money to do that, get as close to you can as paying customers as possible. Letters of intent, documentation that shows us after we invest, there's a quick pipeline to turning on revenue. So there are ways to mitigate that risk.
And when the VCs say that isn't anywhere near enough, I'm speaking from personal experience here.
So VCs have a lot of ways to say no without actually saying no.
Yeah. Just any advice on overcoming that obstacle? Because I'm sure
I think
I'm not the only one to run
you have
into
to
that.
find the right investor and build a relationship with them. I mean, we invest in companies that are pre-revenue. We invest in companies that, they don't even have a plan to make revenue, but they have a really interesting idea, and it's up to us to decide if we're comfortable making that investment. So it is definitely doable.
Yeah, and you don't have to come in with all the answers. There are some offsets to not having traction. So if a company can demonstrate that there's clearly going to be a healthy gross margin, that's important. If there's a good cash management plan, it's important because it provides the longevity to get those customers. And again, like you said, it's important which investors you get, because if you don't have the customers right now, but that investor can help bring you the customers, and that investor can see that, then that could help get over that hump as well.
I just wanted to quickly add, it's a great point. I don't mean to scare any companies away. Investing, in my experience, is all about which compromises are you willing to make versus what promising attributes about the business are you willing to back. So if you don't have customer engagements yet, if the technology is compelling enough, of course we will make a compromise there.
Putting my equity trader hat on for a minute here, the reason these software companies like Facebook and Amazon and all these guys can go for years and years without showing profits is because of the phenomenal growth rates. And investors are willing to pay almost anything for huge growth rates. They're willing to forgive a lot. I don't know how applicable that is to a lot of... Right, growing revenues. So I don't know how applicable that is to hardware tech companies that can't do rapid ramp up. So maybe it's not an apt comparison.
Hi, my name is Daniel. I'm one of the few people who's in the venture market in Europe, I guess. So my question to you is, what do you reckon the pros and cons would be of being in such a dry market from a venture capital perspective?
I guess you probably don't have that much competition. If you've got money to put to work in Europe, there aren't that many people who are, so you probably have a leg up there. There's a lot of very smart people coming out of the academic community in Europe, coming out of sort of various technology hubs like London, Berlin, even Dublin in Ireland, places like that.
Amsterdam?
Of course, yeah. Sorry for leaving it off the list, but I'm sure they're very good. I think it's given how being one of the luxuries we have in Silicon Valley is that within this sort of 40-mile radius of where we're sitting right now, there is a concentration of incredible companies, and I think my sense is that Europe's a lot more fragmented than that. You probably have to spend a lot of time on a plane to find the good deals. So we have a couple of guys working out of an office in London, and they are in Eastern Europe regularly, they're in Scandinavia regularly. That's where they're beating the bushes to find good deals. So I think it's probably a lot more legwork required. Here, people come to me, which is kind of nice.
What's great about European companies in areas that don't have a lot of financing is that they learn, if the team is passionate enough, they learn to be self-sustaining, and they learn to be capital efficient. Those are great attributes to have in a startup.
And also, you don't only need to source your money locally. I think you were touching on that, but a lot of the VCs and angel investors and corporate investors in other countries, and if they don't have it in your country, look for a neighboring country or come to the States to look for money. There are plenty of vehicles that are set up here to invest in non-US companies.
Yeah, in fact, the majority of our investments every year are actually outside the US. We have investors on the ground in 7 or 8 different geographies, ranging from China and Brazil and India to more established markets like Western Europe.
I'm Perry Mistry, and I'm in the high-tech manufacturing, working on chemistry, material science, and packaging validation. I'm also a volunteer at YMCA, at Technology Center at Evergreen Valley, and I come across students who are experienced in programming, coding, and they would like to have access to VC capital or angel investors. I'm trying to know if this panel also takes care of the high school students or community college students who are the best and the brightest mind in Silicon Valley. Do you have any programs for the high school students or community college to invest in their startups?
So there are a few things that those students can do. I mean, the obvious one is look for internships, and a lot of the venture capital companies and a lot of the angel groups and companies, startups themselves, post online jobs that are available and internships that are available. Generally, when we've seen companies come to us where the founders are at the high school or college level, we end up needing to help beef up the team or give them a lot of mentoring. And I'm not saying that at that stage that it can't be done. People have done stuff at all sorts of different stages, but we're talking about probabilities and likelihood. So at that level, really I would say look for internships, look for job postings, and an internship might be a great opportunity to test out the viability of the concept. You learn more in an environment in a company that's doing something similar to what you envision.
Yeah, no, I would agree. And I think if you look, there's a number of very, very well-established Silicon Valley investors. Look what Peter Thiel is doing with his 20 Under 20 program, right? He's encouraging people who are at that stage in their careers to take a chance. He'll fund them for a couple of years, and they can go out and explore this idea that they have. So there's definitely people who are focused on it.
I'm glad you mentioned that, because you reminded me also, Nanorex has launched the Dream Up program. So for young space entrepreneurs that have an idea that they want to commercialize or at least have the opportunity to develop, dreamup.org and other opportunities like that are fantastic.
Good evening. My name is Mike Broom. Some of you commented on the importance of an entrepreneur with leadership skills and the willingness to be adaptive or coached. How would you, as investors, measure or value entrepreneurs who are veterans with military experience? And what advice would you have for new or aspiring entrepreneurs that don't necessarily have all the answers, but certainly have the perseverance or the persistence skills and are willing to see it through?
I'm not sure I quite have exactly an answer, but I think a military background is actually an asset because you have to have the ability to execute in many ways, and a lot of people without that discipline don't ever have the opportunity to learn it and may not be capable of achieving the same goals. So a military background to me is an asset in many cases, but it's only the only thing, and it really depends on what else you're doing. As far as developing the team, I think other people may have a better answer.
I'm not sure I do have a better answer. That's a personal question. Thank you for your service. And it absolutely goes in the plus column.
Online, what Josh said, thank you for your service. And a military background, again, it depends on what you did in the military. So people who haven't been in the military look at it very, it's a monolithic thing. But it depends, what did you do in the military? And is the role that you had something that serves the skill set that you're going to need for your company? So if you were an officer in an administrative unit, or if you were military counsel, or if you had weapons experience, or if you had some kind of specifically applicable to what you want to do in the startup, it's almost like another point on the resume, just like any other set of experience. If you can leverage your military background to get some kind of grant, that could be helpful, and that would help an investor get more comfortable, because then they know that the dollars that they're putting in for equity is getting leveraged because it's got some grant money that's supporting it as well. So that's non-dilutive investment into the company.
Somebody with a military background, I make certain assumptions. I assume that they have more of a structured mindset than maybe somebody who didn't. I look at what they've done in the military and see if they've developed any leadership skills there, but it doesn't answer the question one way or the other on the entrepreneurship. That's a completely separate analysis.
Yeah, I think I'd echo all these comments. Operationally, I could see it being a strength, but I think it comes down to that entrepreneurship spark, and that's something that gets evaluated separately.
Thank you.
Hi, my name's Neil. How much does valuation matter in the funding process?
I would encourage any entrepreneur not to fixate on valuation. It's one piece of the negotiation process, and if I was an entrepreneur, I'd be much more concerned about control. If I'm a VC and I offer you $100 zillion pre-money valuation for your company, but I want to control the board, that's a sucky deal for you.
It's a negotiating point, just like you're saying, and sometimes we even look at how strategically the question of valuation is being approached more than the valuation itself.
You have to be a little careful with the valuation, because when you're raising money, it's oftentimes not the last time you're going to raise money. And when you go to do your next round, you have to take into account the valuation you placed the first time and give your first round of investors a better deal than your next round. And suddenly, depending upon how many rounds you're raising, you're getting to numbers that maybe you can't support.
If you want to do some research on the topic, I encourage you to watch Silicon Valley on HBO. Scarily true to reality.
All right, thank you.
I think actually just one more comment, you'll often find a VC will say, sure, your valuation, my terms. So.
I'm going to ask a question about, I'm from DC, work in that part of the world, and I was going to ask how much you care about the government as a customer for some of these early startups, but I think I know the answer. It's close to zero. So let me ask a different question.
Good choice.
Yeah. Recently, one part of this industry that the government has been flooding money into is space security, domain awareness, and things like that. how much do you care about that? Or how much do other companies that you're looking at care about that? Does that question make sense?
I think so. On the first question, which I think is a good question, is government revenue is still revenue. If we looked at the same exact company, one was selling on similar amounts to commercial, one was selling to government, I think we'd be biased towards commercial because of the long selling cycle that government generally takes. But it can still be interesting. On the second question, I think that there's a mentality that, at least on the earlier side of things, where we are trading in space so far in terms of investment, by the time that the issues of privacy, if that's where you're going, no.
No, not privacy, although it could lead to that, but more about the awareness of the domain of space, of what's up there, what's happening, and the protection of the assets in space. So either maneuvering or offensive or defensive capabilities, how much do companies care about protecting their assets once they're in space?
So certainly for the stuff we've been looking at, which is around the sort of emerging CubeSat form factor, those things are on like an 18-month replacement cycle anyway. So do I really care? I mean, I'm kind of relying on sort of cell phone technology and the incredible sort of advances that we see from Moore's law every 2 years to 2.5 years. So I'll be replacing my constellation on a pretty regular basis anyway. I think for a more legacy company, it's putting up a really expensive piece of hardware that they expect to be operating for 20, 25, 30-year lifetimes. That's probably much more important. But it's not something we really consider at all.
It's my hope that before that becomes a really critical issue, propulsion technology helps steer some of the objects. But there is a lot of debris. I think it's a question that's going to become more and more relevant, but not something that's top of mind for us. And I'm not sure if it's a commercial solution or a regulatory solution that addresses it.
Okay, so before we close, I just want to say a special thank you to Ofer Lapid, our partner at Space Nest Israel, who was my sounding board in preparing some of the questions for tonight. And I sincerely want to thank our panelists who came and will be around afterwards to hear your pitches and questions and ideas and hopefully connect on an investment. So thank you.